Hey guys, I had a question from somebody in using a fund of funds. Now this will apply to anybody. There are a lot of mutual fund companies that do funds of funds, which is a mutual fund that owns other mutual funds. It was regarding volatility in an investment portfolio. Now let's say that you're getting near to retirement. You want to reduce the volatility of your portfolio. You might look at adding bonds and those types of things. It's one of the obvious things. Now, one of the things that reduces volatility, however, is making sure that you own stocks in different asset classes, large companies, small companies, value companies, and so on and so forth. What happens sometimes is if you own it in a fund of funds, like for example, I have a fund that's investing in U.S. stocks, but maybe it has one fund inside of it that's large, small, value, and small value and microcap or something like that. And I see that volatility, and this person was questioning, says, well, why is there still that volatility? I should have less volatility. I'm so diversified. Well, let me explain a concept. For example, in a period of time in January, we took it was about a 1 week period, we found that a portfolio between two stock asset classes went down about 1% over that 1 week period. Now, over that same period, you think, well, gee, I didn't get any reduction in volatility. No, you actually did, and in this particular case, there was. Because what happened, you had one asset class or a few asset classes that went down significantly, about 3%. Some of them went up about 1%. But here's the real issue. The ones that went down more than the ones that went up. So therefore, the portfolio went down in value. Now, what happens is if I'm taking an income from a portfolio, in retirement, I can actually benefit from this because the asset category that went up in value, that's where we're going to take the income. Now, overall, if I'm in retirement, I can have a portfolio with half stocks and half bonds and be very successful in retirement because I've reduced volatility by adding bonds. Same deal with bonds. If I have a situation where the stock market goes down, but I own bonds that go up, I can have a portfolio that goes down in value, yet even though stocks went down more than bonds, my portfolio, because bonds don't go up as much as stocks went down, then I have a portfolio that goes down in value. But because I'm taking an income from the area of the market that just had good performance, namely in my example, bonds, I can be just fine, even with a portfolio that goes down in value in retirement. My whole idea behind stocks, as I always say, is to make sure to protect against long-term depreciation of the dollar, which is what we call inflation. Hope that helps understand why you can still have volatility and be successful in retirement. We'll catch you next time.